Okay, so good evening, everyone. And this is CR March, July 2020. So we'll be looking at the question one. If time permits, we'll go to question two. So I will just touch some important area that we need to know. Although we have done all the group aspects in CR, so this is just a kind of revision. So I'm reading from here. Question one, Dorodo PSC acquires 65 million shares in Gorogo Limited on January 1st, 2019, and extracts of the statements of changes in equity for Gorogo Limited, Gorogoro Limited, for the year ended December 31st, 2018 is presented below. So all figure assume correct. Then we move on. Additional information. This is where we need to take note of the consideration agreed for the acquisition of shares in Gorogoro Limited were as follows. Cash payments, 65 million naira. Now, if you look at this acquisition, it's coming in four ways. Is it four? It's coming in three ways. The first one is share acquisition. Another one is cash payments. Another one, which is B part now. They said 30 million naira to be paid 3 years after the date of acquisition. And the relevant discount rate is 10%. In this case, they are talking about deferred consideration. Then in C, if the group meets specified targets at a future date, there will be a further payment with a fair value of 30 million naira at a later date. This is what we call contingency acquisition. Now, in this question alone, you are having almost four ways to acquire a subsidiary, which is a full question on how to test the acquisition. So we have cash payments, we have deferred consideration, we have contingent consideration from this question. Okay, let's continue. Then the C part now. If the group meets specified targets, I think we've done this. We just finished reading this. Now, upon your review, you note that Doro only recorded the cash consideration paid. So they have recorded cash consideration paid in first one, above in his statement of financial position. Okay, then II, on January 1st, 2019, Doro also purchased all the 100 shares or 100 million shares. Okay, so this person is I4. Let me try to confirm from her. Okay, so let's continue. So what you are saying is this. He said, upon your review, you note that Doro only recorded the cash consideration paid in I, then above in a statement of financial position. Now, on January, just a minute, let me check. Okay, so let me check if this person is in. Okay, she's in. So she can continue. Now, on January 2019, Doro Doro also purchased all the 100 million shares of 50 kobo each in Asororo Limited for 55 million naira, when the accumulated profits in Asororo was 9.8 million. Following the share purchase, Doro Doro obtained control of the board of Asororo. Then note 3, goodwill is to be calculated using proportionate method. Don't forget we have two ways of calculating this goodwill. We have proportionate, we have fair value, or let's say NCI. You can use proportionate to calculate NCI, and you can use fair value to calculate goodwill or NCI. So in this case, they will tell you which one you should use. They will tell you it is the policy of the company to value NCI on proportionate basis or on fair value. But in a case or in a question where you were not told either proportionate or fair value, you have to use the proportionate. Proportionate is the principal, it's the primary method. So we only use fair value if they otherwise tell you to do so. And they're going to give you the value in the question. We've done all those ones in class. And is subject to an annual impairment review at the year end. Goodwill on the acquisition of Goro Goro was determined to be impaired by 10%. So there's going to be an impairment on this question of goodwill. Then note 4, plant and equipment held by Goro Goro, which had a remaining useful life of 5 years, had a carrying amount of 10 million naira at the date of acquisition and a fair value of 12 million naira at the date, at the same date. So what you are seeing here is at the date of acquisition. Now let me tell you something again. Any additional information that you have at the date of acquisition will be adjusted for before you get your goodwill. So we do that when we get there. If it is at the date of acquisition and it's part of asset of subsidiary, you must adjust for it before you get your goodwill. Now, note 5, at December 31st, 2019, Doro Doro current account, which Goro Goro was 5 million debits. So they are talking about the current account, which did not reconcile with the equivalent balance in the books of Goro Goro. The difference is due to goods in transit sent to Goro Goro on December 27. The invoice at 3 million naira. The goods has not been marked as received in the warehouse of Goro Goro until after year end and were sold to Goro Goro at cost plus. When you see cost plus, they are talking about markup. Okay, and we all know how to calculate our markup. Markup, you add the percentage plus 100, which make it 150, then divided by 100, multiply it by the figure. So when we get there, we know what to do. And from here, we will also calculate unrealized profits from this question. Okay, so note 5. Doro Doro issue 5 years 0 coupon bond of 35 million on January 1st, 2019. The bonds are to be redeemed at 46 million 725. Now let's look at it. For those who are doing SFL or those who have done SFL, 35 million naira on January 1st. Then the redeem price is 46. Doro has recorded the net proceed of 34912 less the issue cost in its statement of financial position. When we get there, we adjust for that as well. The accounts for all companies are made up to 31st December, and the draft statements of financial position for Goro, Goro, and Asororo for 2019 are as follows. So all figure assume correct. Now, requirements. Prepare the consolidated statements of financial position for the Doro group for year ended 31st December 2019. That is just 25 marks. So we are going to start the calculation now, but you are going to do something for me. I've sent this March, July 2020 into the platform. Just open it from your hand so that you'll be able to supply answers or numbers or figures as we move on. Because we are going to need figures so that you'll be able to supply figures without wasting our time. So let's start with that. So I'm going to unshare this. Okay. So I will need to remove all this so that we can make use of that space. Okay, so I will start the workings. I will start with workings. I want to believe that working on group accounts is not new to you. You know the attack you need to use. You open all the financial statements once and for all, and then you only adjust for the one that has additional notes. So that will not be a problem. But from my own end here, the first thing I will do is group structure. So how do we calculate group structure? The first thing to do from here is to get our group structure right. So if the group structure is right, no issue. Now I want you to go to the first line on that question. They said Doro acquired 65 million shares. Can we all see that? Can you go back to the question and check for us? You can unmute yourself and let's discuss. This is professional class.
Yes.
Okay, so we have acquired 65 million shares. Now, in this case, we see that they didn't give us the group structure on a platter of gold, and we need to calculate that ourselves, which is fine. So they acquired 65 million shares out of how many shares? Out of 100 shares. Let's go back to that question so that you'll be sure of what I'm talking about. This is it here. They said Doro acquired 65 million shares. This is the figure. So they acquired 65 million out of how many shares? Doro has 100 million shares. Okay. So it have 100 million shares. So we are going back to that question now. That's workings now. Sorry. Okay, so out of 100 million shares. So what do we need to do? All we need to do is convert 60 million or 65 million, sorry, divided by 100. Then multiply by 100%. What do we get? What do we get, please? Just press your calculator.
65.
65.
65%. So 65%, is that a control? Yes, it has control because it's more than 51%. So that is the first one. So I will just try to use some shape. So let me use this to explain it. Okay. So the name of the group is Doro Doro. And Doro Doro acquired who? Acquired Goro Goro. Okay. And what is the, we have 65%, which is for the parents. Let me just leave it here as 65%. So I will put it under here, 65% for parents. So if 65% is parents, it means 35, right, will be for NCI. Are we good with that? Now let's look for the second question. Let's go back to that question. What is the control in Asororo? So they said on January 1st, 2019, Doro Doro also purchased all the shares of 50 kobo each in Asororo. So they acquired everything. This is 100 million shares. What is the share capital of Asororo? The share capital of Asororo is 50 million naira. Okay, but they said the price of that share is 50 kobo. Where is it again? So they said it's 50 kobo naira. 50 kobo. So we have to go back to the question and also convert it. So I'm going to do that here. So this is for Asororo, and this is for Gororo Go. Goro. Okay. So we want to calculate the one of Asororo now. Now they acquired 100 million shares. 100 million shares. Okay. Then out of how many shares they have, they didn't give us the number of shares they have, but they gave us the price of that to be 50 million in the question. But they said it is the price of one share is 0.5, which is 50 kobo. So let's calculate this first. What do we get? 50 million naira divided by 50 kobo. What do we get?
100.
100. So that is 100 million shares. You must make sure you convert it to shares as well. So we have 100 million shares. So therefore, they acquired 100 million shares divided by what is the total shares they have? They have 100 million shares as well. So what is they multiply by 100%. So group structure should be what? They acquire
100%.
100%. So it means we are going to draw another line and we say this name will now be Asororo. And what is the, okay, or let's leave this. Let's call this place 100%. And let's put the name here. And we are good to go. So for Asororo, there's no NCR at all. They acquired everything. I believe we are good with that. That is working 1. So working 2 now, let's call this number 2. What is the next thing to calculate? The next thing to calculate now is our goodwill. Or let's calculate, yes, let's calculate our goodwill first. So let's say computation. Or before that, let's call this
Yes,
question
perfect.
2. Let's call it purchase consideration, because we are not giving on a platter of gold as well. Let's call it purchase consideration. So we want to calculate the purchase consideration now. What do we need to do? In this question, they said they acquired the first one. I will call this one A, which is cash. Yes, they said they acquired it for how much? The one of cash is how much in the question?
65 million naira.
So 65 million naira. Then for B, we have the one of the deferred consideration. I'm going to go back there to see deferred consideration, which is note 2. Consideration. Okay, I'm coming. Okay, so let's go back to that note and see what they are trying to explain to us. Deferred consideration, which is note 2. So they said 30 million naira to be paid 3 years after the date of acquisition. And the relevant discount rate is 10%. I believe you can all see that. So this 30 million naira you are seeing, it is the future cash flow. It is not present value of that cash. So what do we need to do? We need to calculate the present value of this 30,000 or this 30 million. So what do we need to do to calculate that? We will go back to that to calculate. So let's come back. So we have the formula for future cash flow to present cash flow. Present cash flow is equals to, let me call this so that not this, is equals to cash flow divided by 1 plus R, then raised to power n. Okay, this should be raised to power n. Let me see if I can achieve that, which is fine. So this is how it should look like. So now we want to convert that future cash flow to present cash flow. What are we going to have? The present cash flow will be PV equals to, what is the cash flow we are talking about? 30 million naira, right?
Yes.
Then divided by, what is this figure? We said 1.
0.3.
Okay, so I should just forget the remaining one, right? We all know how to calculate that. So the R in that question is 10%, which is 0.10. So if you change the number of years is 3 years. Okay, so when you divide that, what do you get? 0. What? Hello?
Uh,
Do you do you do you get that?
Who's coming again?
For that formula, can we do 1 plus r raised to power minus n, or it has to be 1 plus r raised to n? I'm confused.
Okay, so okay, let me do that then. So it's going to be 1 plus 0.1. You know, in that question, the percentage is 10%. So 1 is constant. Then raised to power 3 years. We are talking about 3 years in the question. So you just raise it up by this. So press this figure. What do we have from the calculation?
We have 1.331.
So 1.331.
1.331.
Okay, so
Yes.
30 million divided by 1.331. What do we get?
We have 225
225
39
39.
444.
Okay, let's do it this way because we are writing in thousands. Okay, let's remove this 3,000. Let's use 30,000. What do we get?
Okay, come on, sir. We have it as 22539.
39.
22539. Like this, right?
Yes, sir.
Then
Okay.
point 44 something.
Okay.
444.
Okay, so let's leave it this way. So this is the deferred consideration as at now. That is the other aspect. Then the part C now. The part C from here, let me just put it there. The part C in this question will be contingency consideration. Contingent consideration. And from that question, how much is the figure? They said, let me go back there to see what is that contingent talking about there. So that would be the second part of it. Now they said, if the group meets specified targets at a future date, there will be a further payment with a fair value. Now, why are we not converting this now? They said with a fair value of 30 million naira. What happened if the group did not meet that target? They will not pay that 30 million naira. But if they meet the target, they will pay additional 30 million. So that is a contingent. Okay, so that's why we have that as another consideration on our list. So we are going to have 30 million naira. So I'll call it 30,000 to write it in thousands. And that is fine. So we are done with the consideration. The next thing to do now is to get our pre-acquisition retained earnings and the post-acquisition retained earnings. So let me just put it as post. Now, what do we need to do from this question? We have some work to do. Let me try to correct this. Okay. So we are going to say, what is the first retained earnings we have there? We have retained earnings, let me say, at acquisition. Let's call this at acquisition. Okay, so we are trying to get our retained earning at acquisition and at consolidation. Okay, so let's leave it this way. Now, at acquisition, the retained earning, can you go back to that acquisition? How much was the retained earning at the acquisition of Goro Goro? Let's put this one as Goro Goro. Can we identify? Can you get it where it's hiding? Let's go back and see. This is the retained.
2,560.
No, for Goro Goro, this statement you are seeing here is for Goro Goro, and they have given us that. They said in 2018 they have 10,000. Then they add additional in that year, which is 12,000. So at the date of acquisition, what is the retained earning of Goro Goro? The retained earning at the date of acquisition is 12 million naira. Do we get that?
Yes.
Okay. So it means we are going to pick this 12 million naira as pre-acquisition.
Sorry, are you referring to that statement of changes in equity?
Yes, yes.
Is it same as retained earning?
Yes, this is retained earning. Retained earning is previous profit. Is previous profit plus the current profit. That is retained earning. What you have or what you have been bringing from the previous year, then plus that particular year. So in this case now, they call it accumulated profit. And this is as of December 2018, which is the date of the acquisition. Someone is asking question. I can't hear anything. Others can hear. Maybe if you connect your mic. You are here to connect your mic. Maybe that's why. Sorry, let me just reply so that connect your mic so that you can hear. Okay, trying to join again. Okay, so do you understand what I said? Are we fine with that?
Yes, thank you.
Yeah.
Okay, all right. So we are going to pick that 12,000 now as our pre-acquisition. Then what will now be our post-acquisition retained earnings? What is the ending retained earnings given to us in this question? The ending retained earnings of Goro Goro is 256. Can we see that? Then ending retained earnings of Asororo is 29,800. Okay. Now, this is not post-acquisition retained earning. Don't get me wrong. This 2,560 is not post-acquisition. Then 29,800 is not post-acquisition. What it means is that the beginning, the retained earning at the date of acquisition is part of this one already. So we need to adjust for that. Then for Asororo, they gave us their own retained earnings at the date of acquisition as well. So this is it here. They said profit in Asororo. They said accumulated profit in Asororo was 9.8 million. Okay, so this is also pre-acquisition for Asororo. I believe that person can hear me now. If you can hear me now, just say aye so that we are fine to go.
Yes, I can
Okay,
hear you. Thank you.
all right. Okay, so let's go back to our workings now. Don't forget the figures we are going to make use of. So I'm going to call this Goro Goro. So Goro retained earnings at acquisition was 12 million naira. We will call it 12,000. As we said, was going to be in this format. That's how they gave us. Okay, then what do we have as post retained earning? That is at the date of acquisition. What do we have? We have 2,560.
2,560.
Okay, fine. 2,560. That is what we have. That is at the date of acquisition. So now, all we want to do, which we are going to do that later now, then for Asororo, at the date of acquisition, what do we have? For Asororo, so at the date of acquisition,
9.8 million.
9.8 million. So I'm going to write 9,800, right? Then for at the date of consolidation, what do we have?
29,800.
29,800, which is fine. Okay, so no issue with that. So we're going to do that later when we are ready to do. So we are going to look at what is the difference between this and that. So if this is the date of acquisition, and this is what they get at the end as a post, I mean, as at the date of consolidation, what will not be the post? What should be the post of here?
The difference.
So the difference will be the post. Fine. So if you can post, so post should be giving us the 20 million here. This will be 20 million or 20,000. Then for this, what will be the difference as well?
Bracket 9,440.
Okay, 9,940.
440.
440.
Yes.
Okay. So we are good to go. So let's move on now. So let's just come back to
Okay, please, that Guru post acquisition retained earnings, is it not supposed to be 14,560?
it's not supposed to be what?
Since it's both negative.
Yes, it says it's supposed to be what?
I'm asking that, is it not supposed to be 14,560 since they are both negative?
Okay, so this one is what? Is positive at the beginning, then they make additional profit. And they give us
Okay.
20 at the beginning, right? Then this one is like a loss at the beginning. Then the loss has reduced to 2. So this one is supposed to be positive,
I feel it's additional loss, yes.
right? So it means
Yes.
they've made some profit to have reduced that to that point. Are we okay with that? Are we okay with that now? Or it's not clear so that I can explain again?
It's not clear, please.
not
I
clear.
feel
It's
it's
not
additional loss.
Okay, so at the beginning you have 12,000 loss. Okay, and it's supposed to be accumulating. But when you now look at your loss at the end of the year, you find out that you have 1,000 loss. Don't forget the accumulated is the beginning plus the ending. So what do you think it has happened? Do you think you made loss additional or you make profit? Or let's do it this way. Your bank account was minus 10,000 at the beginning of January. But at the end of January, you are having minus 2,000. What do you think has happened?
Yeah, there's an additional money, like mean additional gain.
So additional gain has come in, right?
Yes.
So the same thing happens here. Are we good to go?
Okay, sorry, sir. If I get what you're saying. Now, in this question, now at acquisition, then there was a loss of 12,000 naira.
Loss, yes.
Then at consolidation, that means at the end of the year, their loss reduced to 2,560.
The loss has reduced to 2.5.
Okay. So
So
that
for
means
them
they
to,
made an additional gain during the period.
yeah, so there's a profit in that period, which has reduced that to that figure. Are we okay with that?
Yes. Okay, so my question now is, what if in a situation where at consolidation it's a positive figure and at acquisition it's a negative figure?
Now look at this.
Are we still
At acquisition, you have 98 profit. Then at the end of that year, your profit has increased to 29. What do you think has happened? It means you made additional profit of 20,000. Yes or no?
yes.
Now, at the beginning of this, you are owing, let's use it this way. Like you are owing somebody 12,000, but at the end of that year, you are no more owing the person 12,000. What you are now owing is 2,500. What do you think has happened? It means you have given additional money to have reduced that profit, that loss, that credit to that particular amount. So the same thing, you have a loss of 12,000 at the beginning, then at the end, it has reduced. So it means there's a profit that has reduced that money. And don't forget, to get to this consolidation is the beginning profit. Maybe that's where the problem is coming from. Opening profit plus brought forward profit. Do you understand that? So opening
No.
profit. Okay, so instead of this opening, let's call it current. Current profit plus brought forward profit. That is how to get this consolidation. Am I right?
Yes.
Good. So this is the current here. At the date of acquisition is this. Now to get this consolidation, it means this post is the current profit. Why this 980 is the brought forward profit. So brought forward plus post will give you consolidation. Then brought forward plus current will give you 2.5. If you want to test it now, 12,000 plus 9440 is going to give you the middle one. Are we convinced now?
Yes, sir.
Okay, fine. So let's continue if there's no more issue. So that is what we are going to use in the course of our calculation. So we are going to say goodwill, or let's call it computation of goodwill. Okay. To calculate our goodwill, we need our purchase consideration. So I'm going to say purchase consideration So for purchase consideration, we have one, we have cash, which we have calculated. How much is for the cash? 65,000.
I'm sorry, sir.
Okay.
And I'm sorry, a question. I want to draw us back to the purchase consideration aspects.
Okay.
Go through one of the questions you solved in class where they had computation for purchase consideration.
Okay.
What you did there was you multiply the amount multiplied by the 1 plus r raised power minus 2. That's what you use that question. So coming to this place now, we are using divided by 1 plus r raised power 3.
Now, if you look at the question, it's going to be in another way around. There's future cash flow. There is present cash flow. It depends on how they put the question. If you want to convert future cash flow to present cash flow, you do that. If you want to convert future cash flow to present cash flow, you do the other way around. Is it clear now?
Yes.
So that's what happened. Just study the two. You will see how what happened. That is going to be opposite of the two. One future
All
to
right.
cash to future. I mean future to present. The other one present to future. In that. Okay, so we've done that to be that. Then the other one is deferred consideration. So how much is deferred consideration? Up to what?
22539.
539. Okay. Then what again do we have? We have contingency, right? So
Contingency.
contingent consideration. How much is that? 30,000, right?
30. Yes.
Okay. So we are through with this. Now, they said the next thing to do is NCI.
Sorry, sir. Are we not factoring the shares, the acquired shares? Or it's not relevant in this case.
The acquired shares, right? Let's go back to that question and see. They have control before. So they only make additional control. So if you look at it, they said they have 65 million shares in Gorogoro Limited. So we only use this to calculate the group structure. So the main consideration now, as at that date, is the cash, the fact consideration, and then the contingent.
Okay.
You understand now? If you look at it, you see that they didn't
Yes,
even
sir.
give you, they didn't give you any information on what is the share price to multiply with this figure, because they know that
Yes,
it's not
sir.
necessary. Okay, so are we fine with that? Okay, if it's not clear, just ask and let's discuss so that it will be clear. Okay, so we have this figure. They said we should calculate it at proportionate method. So at proportionate, it means we are going to have the nets then multiplied by 35% for Gorogoro. So let me put this one. It's going to be in two ways. Gorogoro here. Then for the other one is Asororo, which I believe is fine. So for Asororo, what is the consideration? What is the consideration for Asororo? Can we check that? Is in their notes. I think note 1 or note 2.
They said they purchased all the 100 shares of
Asororo.
55
they said
million.
55.
Sorry,
55 million.
55. So let's call it 55,000. We are writing in thousand. Okay. So there's no deferred consideration in this case. So we leave it. There's no contingency in this case. We also leave it. Then, because the purchase, the acquisition is 100%, there is no NCI. Do we agree with that?
Yes.
Fine. So now the next thing to do is to calculate our net asset. Net asset of subsidiary. Of subsidiary. Okay. So what is net asset? What are the net assets of subsidiary? I'm sure shares is going to be there. Share capital.
Yes.
So how much is share capital for as Goro Goro?
100,000.
100,000. Then for Asororo, what is the share capital?
50,000.
50,000. Okay. Apart from share capital, is there any other thing they have?
Retained earnings.
And
So we are going
pre-acquisition
to
retained.
use retained earnings. Pre-acquisition retained earnings. So for Goro Goro, how much is for Goro Goro? I think we calculated that already. How much is that? 944 now. Yes or no?
Yeah.
Nice.
No, that's supposed.
That's proposed.
That's proposed.
Yes.
No, no. Let's check.
At acquisition.
Okay, for this one, Abby. So at acquisition is minus 12, Abby.
Yes.
12,000.
Okay, so 12,000. So we have 12,000. Then for this one, what is it?
9,800.
9,800.
9,800.
Check on my table.
Sorry? So let's add it together. What do we get? But before that, there's an adjustment at the date of acquisition, right?
Yes.
So they said one plant. Instead, let's go back there to see the story. Let's get the gist there. So note 4, plants and equipment held by Goro Goro, which had a remaining useful life of 5 years, had a carrying amount of 10 million naira at the date of acquisition and a fair value of 12 million naira. So the carrying amount is 10 million, but at the date of acquisition, the fair value is 12 million. So we need to calculate that in our figure. So we are going to say, let's call it P and M, right? So how much is that? It was 12 minus 10. And we have how much?
2,000.
2,000. So 2,000. So it means they undervalue the net asset of that subsidiary. Okay. So that is what we have. So this one is 0. I believe we are good with that.
I
So
have a
let's add.
question.
Okay.
Okay, the retained earnings, are we not including the one of the date of consolidation at consolidation?
No, you only recognize the one at the date of acquisition. Okay, then you now share posts between NCI and subsidiary later.
Okay.
So you don't need to, this one is just, they're only giving you to determine your post. They are giving you to determine your post. So without this, you won't be able to determine your post acquisition retained earnings. That's why they are giving you. Okay, so what is the addition of this figure here? Let's add it together. What do we get? I think this is
We've not
90.
computed for NCI.
Eh?
Okay.
Yes, we will
That is
compute for it. We will compute for it.
90,000.
90. So how about this second one? 59,800, have you?
Yes.
Now, because it's at proportionate method means the value of your net asset or subsidiary multiplied by the NCI percentage. So what is the value of subsidiary here? 90,000. Multiply it by percentage of NCI. What do we have? %35 of that. Sorry.
31,000.
31,500.
31,500.
150.
31,500.
Okay, 500. Thank you.
Yes.
Okay, so we'll find the total value of this. And we'll find the total value of this. So let's add this together now. What do we have? 65 plus 2, 539 plus 30 plus 31, 500. What do we have?
We have 149,039.
149.
039.
039. So this will be 55,000. Now to get our goodwill, goodwill is, maybe I should put it here, or there's no need of putting that there, is total consideration here plus NCI minus net asset or subsidiary. What do we have? So 149 minus 90, what do we get?
Fifty-nine zero three nine.
Sorry?
59,039.
59, Abby?
Yes, 59.
039.
Yes, sir.
Okay. So how about the second one?
Minus 4,800.
Minus 4,800.
800.
Now, this is goodwill as at this date. But if you read the question, they said the goodwill have been impaired by how much?
10%.
By 10%. So you're going to say impairment of goodwill at 10%. So let's just put 10% here. So what is 10% of this figure? Of the goodwill? . 10%.
5903.9.
Again, sorry.
5903 point.
5903.
3.9.
Abi,
9. Yes, 0.9.
0.9. Can we leave the points and make it whole number?
So yes, that's 5904.
5904.
4. Okay, fine. So how about the second one? What do we have?
480.
Is the second one impaired in the question? They didn't tell us that. They
No.
didn't tell us it is impaired. It's only Goro that is impaired. Yes or no?
Yes.
Good. So it means our goodwill now, which we are going to put in our financial statement, would be just minus from that. What do we get? 59,039 minus this figure. What do we get?
53.35.
53135.
Sorry?
53135.
535.
53135.
One.
1
Okay, 53135.
135.
Okay. Are we okay like this?
One.
Yes.
135.
135.
Okay, 135. Like this, right?
Yes.
Okay, so how about the second one?
135. No. No.
Okay.
135.
135.
135.
Oh, 35. Like this, right?
Yes.
Okay.
Yes,
Yes.
sir.
So how about this one?
400.
So it's still going to remain
Right.
the
Before we
same,
finish.
or it's going to
Minus
be
4,000.
negative. So what we are going to recognize is going to be net of these two as our goodwill in financial statement. Are we good to go with this?
Yes.
Okay.
Yes.
So that is the goodwill which we have calculated. Now in your exam, don't use this one I'm using. No. Open your financial statement ready. Don't do the calculation first. Open your financial statement ready. Post everything necessary. Anything that doesn't have adjustments, post them and ask them and add them together. Then the one that has calculation, you can now be adjusting and posting. So like goodwill we just calculated now, we just post it directly to the financial statement. So you must find a way of doing it very fast in your exam. But now we are just trying to solve it one after the other. Okay, so we are good with that now. Let's look at the next calculation. So let's see the one we have done and the one that is left for us to touch. Okay, so let's go back to the question. We have done all the notes and 1. We've done note 2 as well. Note 3 have been done. We've calculated our impairments on Goro. Okay, so note 4 also has been done. But we are here to calculate depreciation. You know, we have calculated the adjustment, so we still need to calculate the depreciation of that, which should be 2,000 divided by 5 years. The difference between the two divided by 5 years, that will be 400. So 2,000 minus 400 will give us 1.6. We are going to adjust that later. Okay. Then note 5. Okay, so we want to do unrealized profits now. So let's go to unrealized profit. So I'm going to read this question again before we calculate that. As at December 31st, 2019, Doro current account with Goro. Now, if you look at this now, we are talking about intercompany receivables and payables. Doro Doro account with Goro Goro was 5 million naira debit. What does that mean? Doro Doro has debit balance of 5 million naira. That is receivable for Doro Doro and payable to Goro Goro. Are we getting that now? Which did not reconcile with equivalent balance in the books of Goro Goro. So it means Doro Doro is having 5 million naira in his own account, but in Goro Goro's account, the intercompany must be the same thing, must correlate, must agree. So if you have 5 million as receivable, then Goro Goro is supposed to have 5 million as payable as well. That's what the question is saying, but that figure does not reconcile. Now, this difference is due to good in transit sent to Goro Goro. So Doro Doro has sent a good or some goods to Goro Goro, which has not been delivered to Goro Goro. And since the goods have not been delivered, Goro Goro is not expected to record it in his own financial statement on December 27. Now, December 27 was when they sent it. How much is that figure? Invoice was 3 million naira. Now, something you have to. Okay, so what we are trying to say is this. We have the difference, the goods which is on transit, which is yet to be delivered to Goro Goro, worth 3 million naira. So what it means is that Goro Goro is not supposed to have, Doro Doro, who is the seller, is not supposed to have recorded it as part of the sales or revenue. But in this case, he must have recorded that 3 million as part of revenue. So that 3 million naira is unrealized. It's not realistic because the person you sent the goods to has not even received the goods. Despite, talk less of sending the money to you. So in that case now, we call that 3 million naira unrealized profit. Another thing you must know when you see questions from intercompany, you must be able to identify the seller and the buyer. So who is the seller here? Doro Doro is the seller, which must have recorded that 3 million as part of his own revenue. So you are going to remove that unrealized profit from the seller. That person who sold the asset, who sold the inventory, must have overstated that profit he reported. So you are going to remove that 1 million naira, that unrealized profit, from his own profit. Another thing from this question is that they said there is cost plus, which is 50%. That is markup. So in this case now, we are going to calculate our markup by saying 50% plus 100% over 100, then multiply by the 3 million naira. So let's go back to that calculation. If there's any question on that, you can ask me. I will go back to that. So this will be note 3 now. And we call this unrealized profit. I'll just call it RP. So how much is the goods that remain in that store? The goods that remain is 3 million naira, which is the invoice. Okay. Then we have to calculate cost plus profit, which is going to be 50% plus 100%, making 150. Then divided by 100, then multiply by 3 million naira we are talking about here. So what do we get? Can you press your calculator? What do we get? Sorry. Anyone with calculator? 150 divided by 100 multiplied by 3,000.
Okay.
Yes, sir.
Okay, so what do we?
4,500.
Huh?
4,500.
4,500.
Okay, sorry. 150.
4,500.
Okay, that's 4,500, right? So it means 4,500 minus 3,000. What do we get?
1,500.
1,500,000.
So it's supposed to be 100 over 150.
Okay, but I
100
was going to
over
ask.
150. Yeah.
I was going to
So what
ask
do we get?
right.
So if you multiply, you get what?
2,000.
2,000. Okay. So 2,000 is the cost of that inventory. So the profits they have added, which is unrealized profit on that goods before selling it, is
Sorry.
3,000. Okay, I'm with you. Just ask your question.
I can see the screen now.
Okay, so are we good? Do you want to ask question or because of the screen?
Yeah.
Sorry.
Please, I have a question.
Okay, yeah, continue.
Okay, I feel this thing is on cost plus, right?
Yes, cost plus.
Cost plus.
Yes.
So I don't understand the format for that cost plus, because the one I understand or what I feel is maybe 50 over 150. So I don't know. I'm not so clear.
That is markup.
Okay.
Markup will be
Okay.
50 over 150.
Okay.
Are we good now?
Yes. Thank you.
All right. So unrealized profit from here is 1 million naira, which is fine. So we adjust to that when we get to where we are going to adjust. So after this, let's go to that question again to see if we have any additional information. Then note 5, we have the one of coupon. So we've done up to this point. So note 5, we must finish this question before 10 o'clock. But what I'm going to do is once you are done with all the normal calculations, I can leave it for you to post it into financial statements. So that will not be a problem. You just consolidate, you merge them together. As assignment that you show me, you share with me if the question agrees or not. That is if you are unable to finish it before 10. But I think we should be able to. Now, note 5 now. Dorodoro issue 5-year zero coupon bonds of 35 million naira on January 1st, 2019. The bonds are to be redeemed at this particular figure. So we have the redeem price already, and we have the normal coupon figure also. Now I've also been in the calculation. So what we need to do here is simple. So all we need to do now is just to calculate that aspect. So don't forget to put the figure in your head as we move on. So we're going to call this node 4. Now from there we have present value of that question. Then 1 plus R, close the bracket, then N equals to future value. Do we still remember this formula we just used? We use this in the deferred consideration. Do we still remember that? When you were doing your PM, this is how to calculate it now. The only thing, the difference between this is that this will not have minus N. But if you are taking present value to future value, it's going to be minus N. That is, you are discounting that figure. But in this case now, you want to take this present value to future value. So it's going to be in positive. I believe what I'm trying to explain is clear anyway. Now, what is the present value of that bond? They said it's 35 million naira, which is 35,000. We are doing this because they didn't give us the coupon rates, which we need to calculate. That is why we are calculating this in this manner. Okay, so that is the figure. Then we have 1 plus, what is the rate? The rate is not given, unknown, but we know the year. The year is how many years? Which is 4 years. It's going to be redeemed in the next 4 years.
I thought it's 5 years.
Yes, it's going to be redeemed in the next 4 years. The first year is always 0. In your PM, if you want to calculate future cash flow, you will start from where? If you have 1, 2, 3, 4. If you want to label it, this will be raised to power 0, 1, 2, 3, 4. Do we get that? You must have done that in your PM, and I mean in your SFM, if you have attended to SFM. Okay, so we have raised to power 4. Don't worry, this is Ican standard question that you must know how to solve. Okay, so equals to, what is the future now given to us in the question? They said it's going to be redeemed at what price? Is it the question?
46,700,000.
46,
725.
okay, 725.
600.
1,000, right? Okay, no problem.
600. But this is 125,000.
Okay, network is bad anyway, but let's just move on. So this is what we have now. So we want to collect the lifetime. Sorry,
Sorry,
you say
sir.
what?
46,725,000. So 600.
600, right?
Yes.
Okay, 600. So if you are writing that 600, it means we are going to write 35 million as well. But we can call this one
So I think
0.6. Should we write it in full?
no.
We should leave it this way. Anyhow you want
Yes.
us to do it. Okay,
Yes.
no problem. Okay, so the next thing to do now is to collect the lighters. Don't forget that you are only looking for R. We are looking for the rates of that coupon. So we can say 1 plus R is still missing. We don't know yet. Then raised to power 4. Okay. Then equals to, then this two number we divide each other, right? So we have 46,725 divided by 35,000. So it means I need to raise this up. Okay, fine. So here now we have 1 plus R raised to power 4. Or let me leave that 4 for now. So what is this? 46,725 divided by 35,000.
1.335.
1.335. So instead of me going back and front, I will just put that 4 here so that I can. So I'm looking for that shape. I'm not sure I have it here. I'm looking for the first square something on my laptop. So let me see if I can have it here. Okay, so let's leave that for now. Let me see from my insert if I have any shape that can use to represent that for now. Let me just use for now. Let me use this for now. Okay. Okay, so I'm using that figure, that shape for now, so that I can move on and move faster this question. So let's come back to the next shape. So what do we have if you press your calculator with that?
1.075.
So I will say R equals to 1.075, 75, right?
Yes.
Then minus 1, because you brought 1 to that step. So what is our R now from that question?
R is 0.075. That's 75%.
So that would be 0.75 or
7, 7.
or
0.07. Sorry, it will be 7.5%. 0.075. If you multiply by 100, you have 7.7, 7.5%.
Okay, 7.5%, right? So are we good with
Yes.
that? Okay. It's supposed to even be 0.7, right? This figure.
Yes, it's correct like that.
Okay, so that is the rate we are going to use in calculating our bond. Okay, so we are good to go with that. So I think I have 2 more calculations to go. The next one is consolidated retained earning. Or let's see that calculation. Do we still have additional information in that question? I think we are done with that. Is the last additional information. So the next thing to do is the consolidated retained earning and the NCI. So I'm going to call this consolidated Retained earnings. Retained earnings. Okay, fine. So what do we have from this now? What is retained earnings as per statement in that question? What is statement as per statement? That is on the financial statement. What do we have?
Two of the parents.
Yes, for the parents.
49065.
49,065. 49.
Yes.
Are you sure? Is it 49 or 40?
49065.
Okay. 49,065. Okay, so after that, what are the other adjustments we have? We have
Post-acquisition.
post-acquisition share. So post-retained earnings. So let me open a bracket. What is the post-acquisition? We have 65% for the parents multiplied by, what is the post-acquisition there?
9,440.
9,440. So what do we have for that? %65 of that. What do we get?
6,136.
6,136.
136.
6,136. Okay, so we have depreciation we need to adjust for. I've explained that when we're so depreciation adjustments.
Sorry, sir. Are we not factoring that of Asororo into this?
Okay, so we should write the Asororo part of.
I'm
So
asking, I have post-acquisition for 2.
Yes, we are going to add its own to it. But this is the parent. When you see consolidated, it's talking about the parents.
Okay.
You understand now? So, but any adjustments from the two subsidiary will also affect the total retained earning of this parent. Okay. So we've calculated this to be 2 million. Sorry. 2,000 divided by 5 will give us 400. Are we good with that? So this will be in negative. Okay. The next thing is unrealized profits, which is here. How much is that? 1,000. We are removing it from here because parents is the one that sold that asset. Are we getting it?
Yes.
Okay. So if Azumi is not the one that sell the that inventory, we won't remove it from here. Okay, so we are going to also share profit from Asororo. So share profit.
My system is down, and there's nothing I can even do for you. Even this night and tomorrow morning, I can't even assist you. Susan is not available by tomorrow, so I don't know what to do for you. Ask your team.
Share profit from Asororo. So let me just put Asororo here. So what do we have for share profit of Asororo? What is the profit of Asoro? Post-profit, post-acquisition.
Post-acquisition, we have
20,000,
20,000. Yes.
20, Abby.
Yes, sir.
Then multiply by, what is the percentage acquisition?
100%.
100. So
100%.
we will recognize the whole 100%. So we are having 20,000 here. So what other thing we have not picked in that question? We picked the one of, so how about the fact consideration? You know, there's going to be interest from the parents. They are the one paying for that future consideration. So we also need to factor in that into the question. So let's look at the default consideration unwinding interest. We are going to calculate that. Okay. Then after that, we are also going to recognize that impairment in Gororo. How much was the impairment again? Our impairment here is 590. So we are going to also recognize that impairment.
5904.
Sorry?
5904.
Yes, so I'm coming. So 5904. Okay. So what else do we supposed to recognize here that we are yet to recognize? So let's go back and see. So we are yet to calculate the one of unwinding this interest. Then after that, we look at the question and see the one we are yet to recognize. And from there, we are good to go. So the unwinding will be very simple. Let me just put it under here. How much is the percentage of that deferred consideration? The percentage is 10%, right? The percentage is 10%, right?
Yes.
For deferred consideration. Then how much are we talking about? From our calculation. How much is the
How much are we?
I mean the present value. Sorry.
22,539.
Okay, this figure 22,539.
Yes.
22,539. I hope we will finish this before the time. So let's multiply. What do we get? 10% of this should be
22,539.
22, right?
Yes, 53.9.
5, 3. Let's call it 4 now, right? Are we good with that?
Okay, yes.
Okay, so we are going to put it in bracket, right? Is it going to be in bracket? Because it's going out now, it's
Going out, yes.
so let's go back to the notes to that question. And let's see the one we are yet to pick. We have picked impairments. We have picked the fact consideration, share profits, depreciation adjustment, post-acquisition retained earnings, and this. So let's go back and see if there's any one we are yet to pick before we conclude on that. I think that is the last calculation. The NCI is simple to calculate. So we have taken this into consideration. But there's one thing we are yet to do here. We are yet to take the issue cost, less issue cost of 87,500 in his statement of financial position. So we need to consider that statement. Okay. Let's see other thing we are yet to take from that question. Then on this bond issue, we calculated that 7.5, but we are yet to use it. So we are going to use that interest as well. I think that is just the two things that remain for now. Let's go to speed. Now we are also, this is 3.5, right? Which is 3 million naira, 50%. This will affect the inventory when we are calculating that. It will affect the inventory when we are computing our financial statement. I think that is just the two things that remain. So let's go back and complete that. So the next one is issue cost. So I want to believe what we have done so far is clear. If it is not clear, let us know so that we can go back to that and do the normal calculation in case if it is not clear. So they gave us that figure in the question already. Issue cost is 87.5. Then we have the interest on bond, which is the last one. We just calculated 7.5%. Then multiply by the figure of that bond as at the dates of consolidation. What do we get? 7.5 times 35. And after that, we add them together. What do we have? 7.5% multiplied by 3,500.
I have 2625.
2625.
2625.
So this also will be in negative because it's an interest. The payment is going out, so it's going to reduce the profits. So this will reduce the profits. This will add to the profits. This also will add to the profit. So can we calculate now? Let's add all these figures together. What do we have as our group retained earnings? Let's know when you get there, when you get to a payment so that I can move it up.
I'm asking payment.
Okay, so we have just two to go.
I have 63731.
Okay, just a minute.
I got 62930.
Wow.
6-2. Oh, which one is correct? Which one is
Nine.
the
I got 63.
6-3? Can we confirm again? 931, Abby. Do you recognize that?
731.
Do you recognize that
Mine is
1,000?
69.
Yes, I did. Minus 1,000.
Okay, maybe the other person. Let's recalculate. Let's know the one that is correct there.
You have to adjust your screen to the beginning.
Okay.
Okay, move the screen, please.
Okay.
It's 62931.
62931. Okay.
Sorry, what are your figures? You have 49065 plus 6136 plus 400.
Minus 400, not plus.
Okay, I think that's my mistake.
Okay. So are we good now?
Yes, we're good.
Okay. So the next one to do now is NCI. So let's do the NCI aspect of it. NCI retained earnings. Okay. So we just need to pick NCI figure from what we have calculated. So NCI, what do we calculate for NCI?
Yes, I have 31,500.
So 31,500. I will stroke to that place so that everybody can see. This is where we are picking the figure from. We've calculated that figure. Where is it again? Yeah. So we've done that here already. So we are picking 31,500 straight away from there to this point. Then what is the share of post profit, post retained earnings? So post retained earning is how much from that question? So we can calculate it. Post retained earning or let me just call it short so that it makes sense. Post retained earning. Then here. So how many do we have? Which one are we calculating?
You have 35%.
35% multiplied by how much? And how much are they sharing?
9,440.
9,440. Okay. So 9,440. So just press. What do we have?
We have 3304.
3304.
3304.
04.
So let me ask, this NCI, is it for Asororo or
Guru
So,
Guru.
so we have to calculate for Asororo, right?
no.
Because
Asoro does not have NCI.
Thank you. So it was 100% acquisition. So there's no NCI for. So this is just the addition we are going to recognize for NCI. So let's add it together. What do we get?
34,804.
34,804. And we are good to go with that.
Okay, sir, a question, please.
Okay. I'm with you. Hello? Continue with your. Let's wait for last person. Or you can ask a
Sorry,
question.
sir.
Okay.
The figure you put is not, the figure is not correct.
Which one?
34,804. This is MSCI written in it. It's 804, not 084.
Okay, this is our addition, right?
First of
That,
all,
okay,
I'm coming. The first, this thing, the post-retained earnings. The answer is 3304.
3304.
04, yes.
Okay. This, right?
Yes. So you now have 34804.
34804.
04.
Like
Yes.
this. Okay.
Yes.
All right.
So I wanted to ask a question.
Okay.
So as when we have NCI for Asururu, we also compute it under here, right?
Yes. So you bring it in. You bring this one in. You put NCI Gorogoro, then NCI Asororo.
Okay.
You understand?
Yes, sir.
Okay. So any other question?
Yes, I have a question, please.
Okay.
Please, can you please define the group structure? Like, we have something like sub, associate, or anything.
Okay. All right. So we have group structure. Let's assume this is group A. And group A has control in B. So whatever the percentage, once is more than 51%. So we call this one direct subsidiary. Okay. Now let's assume that this group A now, which has acquired group B also now acquire C. And let's say this is 60%. I will use another. So let's call this one another line. Now what it means is that this A is the owner of B. B is the owner of C. So this kind of group structure, A has control on B, and because A has control on B, it also has control on C. So we call this one indirect control. A has indirect control on C. But assuming this A now has control in B, and also there is another one. Let's call this one D. And it has control in, let's call this one D, right? Let's call this one 70%. This D and B, they are subs, fellow sub. This is sub to A. This is another sub to A. So they are both fellow sub to A. Are we getting that now? Why this one is indirect sub? Now, assuming this 70% is not up to 70, is less than 51, let's say 50%, or let's say 30%, or 40%, or 49%. This kind of control is called associate. Because A doesn't have control over D. It doesn't have significant control over D. It's less than 51% of control. Then we can also have direct control. That is, A can own B and also own C. And they can also be joined. For example, let's assume A owns 51% in B, B owns 60%, and then A also owns another. I think I need to, we have done indirect subsidiary, indirect control, indirect subsidiary in the previous lecture. I will check the video. I think I still have the video. So I've explained all these things in that video. So you can watch it and then you grab it. But with this explanation on group structure, is it clear, or you still need more explanation on that?
I'm okay. Thank you.
All right. But I can share with you the direct and indirect control and the likes. Okay, so the next thing to do now is to compute these figures together. And this is just 4 minutes to 10, which means we will not be able to complete that. So what we are going to do as assignment, please, all you need to do is just to consolidate. Let's go back to that question and see what we have to do. Because I want us to finish this by that 10 o'clock. So we have Doro Doro, Goro Goro, Asororo. So all you have to do now is to add their financial statements together. So if I want to report this property, plant and equipment, I'm going to say 109 plus 58700 plus 48600. Okay, then I'm going to do the adjustments. That property, plant and equipment, you know, we have 2 million. So instead of adding that 2 million naira, you are going to add the current, the carrying amount, that is 2 million minus that depreciation, which is 400. So it means we'll be adding 1.6 to this property, plant and equipment. Then for intangible assets, there's no additional information on that. You add these three figures together. Investments, you will add investment together. We have only investment in Doro Doro, so other doesn't have investment. Then derivative financial instrument, you add this one. Deferred tax assets, you also recognize this. Then loan, you add it together. Inventory, you will adjust for inventory because of unrealized profit. So that 3 million will be deducted from here. Okay. Then trade and other receivables. This trade other receivables, you will consider that 5 million naira in the note that was as a receivable to Doro Doro, but payable to Goro Goro, but the figure does not agree. So you are going to remove that from here or from the payable. You can adjust it in any of the two, but you have to net it off to have the balance. Then you add all the cash balance together. The three cash balance, you add it together. Then trade payable, you do the adjustment. Accruals, there's no adjustment to that. You add it. Then current tax payable, you add it together. Provision. Then from there, you will also bring in consolidated retained earning of the parents of the NCI, and then you are good to go. Then you are going to recognize what again? The VAT tax, zero coupon bonds. We're going to identify this one as well. So by the time you calculate everything, it has to balance. Total assets must be the same thing with total liability. Are we okay with that? Total assets. Hello? So it means total assets. Yes, so total assets plus, total assets must equals to total liability and equity. That's where you're going to know if it agrees. So let's calculate this. And when we meet, not even before we meet, by tomorrow, you should be able to share on the group. Just send it to the group. We look at it together if it agrees. If it does not agree, we look at it, what should be the problem? And we adjust so that we won't go back to that next time we meet. I don't want us to do this again when we meet. I want us to go to cash flow aspects of group so that we can do thorough revision on the standards and every other thing with the little time we have. Okay, so any other question before we close for today? Some people are sleeping already. That's why they out in the group. So are we good to go?
Yes, sir.
Yes.
All right. Good night.
Good night.
Yeah.